Your wealth deserves stability, expertise, security. Your wealth deserves LGT Crestone, private wealth with over a century of global heritage.
Welcome to the Global View on this Wednesday. Well, global equity markets fell overnight on renewed concerns about China's economic weakness and the strength of the US economy. On Wall Street, the main indices fell as stronger than expected retail sales data stoked worries interest rates could stay higher for longer. Also weighing on the broader market were the banks, with an analyst at Fitch Ratings warning that US institutions, including JP Chase, could be downgraded if the agency further cuts its assessment of the operating environment for the industry. The report sent shares of JP Morgan, Bank of America and Wells Fargo down. Shares of regional lenders of PacWest, Zions and Western Alliance also fell heavily after the Federal Deposit Insurance Corporation's latest regulatory overhaul proposal. Tech stocks shook off some of the negative sentiment led by Nvidia after UBS and Wells Fargo lifted their price target on the stock, which followed bullish comments from Morgan Stanley, with analysts saying investors are piling into the stock ahead of its earnings results next week. US-listed shares of Chinese companies fell, with e-commerce firm Alibaba among those leading the slide after another round of disappointing economic data from China. Elsewhere, General Motors shares slipped into reverse after Berkshire Hathaway cut its stake in the car maker, while Berkshire also revealed a new investment in home builder D.R. Horton, which pushed that stock higher. Why are some investors, particularly in Europe and the US, turning away from stocks with the highest ESG rankings? Well, Sarah Bretton Hughes from American Century Investments discussed the issue of green hushing.
You're seeing the rise of green hushing occurring, and I think it's really two sides of the same coin. But first, to define it, just when we got comfortable with the term greenwashing, where people were overstating their sustainability initiatives, we have now quickly moved to green hushing, where people are understating or being quiet about their sustainability initiatives. I've even heard it as quiet quitting of sustainability initiatives. And I really think it's sort of two sides of the same coin, right? You have increasing regulatory scrutiny globally, where you have had this massive inflection of regulation and policy combined with pushback, whether that's sort of here in the US on sort of ESG backlash or potentially some commitments that have been made that are beginning to look more and more difficult to achieve.
So what essentially companies then, they don't want to be called out if they fall short of those goals, I guess, for ESG, and at the same time, I guess, also in danger that they feel perhaps of greenwashing.
Yes, exactly.
All right, so what are we seeing, I guess, particularly from an investor point of view, of how that's affecting investments, particularly as far as ESG investments are concerned?
Yeah, I think we're at a very interesting time for ESG investing. I think the long-term drivers of sustainable investing are still in place. That's rising sort of consumer demand, this economics driver where you now have so much more of, if you're investing in companies, their balance sheet made up of intangibles versus tangible assets. And the third leg of the stool is the policy leg. And we have seen a significant inflection of policy, much of it driving very favorable tailwinds for sustainable investing. That being said, I'm sitting here in the US where we've had a significant amount of backlash against the term ESG, where it is really, it's more complex than just saying it is political pushback. What we're seeing globally as we had moved to the rise of exclusions and people really concerned that the exclusionary policies that we were seeing in place were going to come after them, their families' jobs, and their economic livelihood. So it's much more complex than we've seen it in terms of a political debate. Where do we go from here? I'm really excited about some of the investment-led initiatives and and really subsidized initiatives that we're seeing. We're seeing great opportunity in the energy transition. We consider it not just an investment risk, but really the investment opportunity of our lifetimes, and really positioning ourselves to invest in a lot of these initiatives. And I think we've moved away from the notion that climate is just a risk. And I think we've also moved away from the notion that we're going to be able to mitigate ourselves out of this. We're going to have to adapt and innovate, and there's going to be a significant amount of money in motion and opportunities to invest in these climate, energy, clean tech solutions.
Well, of course, this comes in the wake of the Inflation Reduction Act 1 year on. So how have those investments actually been performing? And I mean, you talk about how political this has become. How do you set that? How does an investor set that aside and actually look at what's going on underneath?
Yeah, it's really interesting to watch what has occurred. Actually, August 16th is exactly the 1 year anniversary of the passage of the Inflation Reduction Act. And really, that moved, it provided a lot of subsidies to the US economy to invest in both clean tech as well as healthcare. Over 390 billion in tax incentives. You also saw the reaction of Europe pushing through their 250-ish billion euro act as a result, understanding that they were going to have to force not just on sort of climate border taxes and a reduction of the investable universe, but actually respond with an incentive and economic incentives for people to continue to invest. So I think there's some great investments happening. I also think it's really interesting on when you look at the part of the country here in the US and those that have received these fundings, they tend to be within the states and in the areas that you've seen a lot of ESG pushback. A lot of the pushback from anti-ESG has been about exclusionary and boycotting industry. And it's very interesting. Just last Friday here in the US, the Department of Energy announced 2 massive direct air capture projects. And instead, the way the press release was written, it was really focused on the jobs, what it's going to bring to the local economy, and really focusing on the worker and the community. As much as they focused on what that will allow them to achieve in terms of decarbonization. I think what is really interesting and gets talked about less is, yes, we have this massive amount of money to put to work here, but what people don't realize, or it doesn't get talked about as much, is not just here in the US, but many places globally, we're going to need to reinvent the grid. So we're going to need a significant amount in infrastructure spending. We have an issue here in the US that we don't have a nationalized grid. So you have to have the grid is really done state by state, region by region. And the permitting process then becomes increasingly complex. So once a project is complete, it takes around 5 years right now for it to get up on the grid. So unless we have significant permitting reform, which has thus failed in Congress, I'm not quite sure the IRA is going to be the boon that everybody thinks it's going to be. I expect it to get a lot more attention in the coming days just because of that lag and the tax credits running off in 10 years. But what we have seen is a lot of innovation, a lot of onshoring and friendshoring happening, a significant amount in semiconductors, direct air capture, and really the way it's being packaged to the American people in some of these press releases is a big focus on the jobs in the communities. And I think that's important as we're facing the sort of political pushback here. It takes climate change and ESG investing from a Wall Street issue to a Main Street issue.
So, Sarah, what sectors work best with as far as best in progress is concerned?
We think you can get broad-based portfolio exposure across best in progress names. So many people think or think about it as a energy investing in heavy energy or industrial portfolios, but we actually think you can do this in a very key performance indicator, data-driven way to get broad exposure across your portfolio. So yes, it makes sense with energies, with utilities that are transitioning off coal, heavy manufacturing industrials, areas like mining that are often under a pall from a sustainable perspective, but think about all the critical minerals we're going to need for the energy transition. But you can also do it in areas around consumer discretionary when you're working with companies to improve their operational performance, so thus they can compensate their employees better, thus leading to lower turnover, which over time leads to has been academically proven to lead to higher returns. So we think we can get broad-based exposure across all of the sectors we're investing in, as long as you have clear, transparent, data-driven key performance indicators. We found a way to map it back to all of the strategies.
Sarah Bretton Hughes from American Century Investments. That is the global view for this Wednesday. Stay with us. The Open is just around the corner.